Welcome to this explainer. I'm absolutely thrilled you're here today because we're tackling a subject that's honestly incredibly misunderstood, but it is absolutely foundational. We're talking about recourse in commercial real estate finance. Now, if you think recourse is just some simple yes or no box to check on a loan document, well, you're going to want to pay close attention. Today, we're going to completely reframe how you see this whole topic. As you'll see, recourse isn't a binary rule at all. It's actually a highly negotiated, fluid spectrum of risk.
Okay, let's dive into this. Think of our agenda as our prized menu for today's explainer. We've got 5 sections. 1. The textbook myth. 2. The reality of SPVs. 3. The guarantee spectrum. 4. Burn-offs and bad acts. And finally, 5. Pricing the risk.
Kicking things off with Section 1, the textbook myth. Let's examine what everyone thinks they know about recourse. Right off the bat, there's a really stark visual contrast between theory and reality here. On the left side, we've got your standard textbook definition of a recourse loan. It basically says if a borrower defaults and selling the property doesn't cover the debt, the lender can go after the borrower's other personal assets to make up that shortfall. Pretty straightforward, right? Then on the right, we have non-recourse. This means the lender's recovery is strictly limited to the loan collateral. If there's a shortfall, the lender just has to absorb the loss. Now, technically speaking, these definitions are correct. But here's the thing. In the fast-paced world of institutional commercial real estate, they're practically useless on their own.
Which brings us right into Section 2, the reality of SPVs. This is where we pivot sharply from theory to practice.
You see, institutional commercial real estate transactions are almost always structured through a special purpose vehicle, or SPV. By definition, this is a company created to own exactly one asset. It has zero operating history, no other assets, and absolutely no independent financial covenant strength of its own. So think about it for a second. If a lender gives a quote-unquote full recourse loan to an SPV, that recourse is practically worthless. The SPV literally has nothing else to pursue. Because of this, entity-level non-recourse isn't some special concession you have to fight for at the negotiating table. It's actually the market's standard starting point.
So the absolutely crucial point here is separating the loan from the liability. The loan sits with the SPV, sure, but the liability question? That's answered completely separately. The real engine of the deal is the sponsor's guarantee. The true negotiation actually happens one level up. It's all about figuring out exactly what the sponsor, the individual or the fund with the actual balance sheet, personally stands behind.
All right, moving into Section 3, the guarantee spectrum. This is the core concept where we see that recourse really is a dial, not a switch.
Let's walk through this spectrum of risk transfer. Starting at the top, we have full recourse. Now, this is pretty rare for stabilized assets, but it's super common if the sponsor is untested. Moving down, we have partial guarantees, typically a 25 to 50% top slice. These are literally the absolute workhorses of transitional lending because they perfectly bridge that gap between an asset's current performance and its future business plan. Below that, we've got completion guarantees to make sure developer covers cost overruns. Then there are interest and carry guarantees. Those cover debt service until a vacant property is fully leased up. And finally, environmental indemnities, which are unique because they often survive even long after the other obligations are paid off.
There's a great quote I want to read here. A sponsor evaluating loan terms should read the guarantee schedule as a priced menu. And this brilliantly illustrates our main theme today. You shouldn't just be asking if a loan is recourse or non-recourse. That is the old way of thinking. Instead, you need to look at each item on this menu as a specific risk transfer. Every single guarantee has a negotiable value.
Okay, let's head into Section 4, burn-offs and bad acts. These are the hidden, highly negotiated levers of the industry. The thing is, these obligations aren't always meant to last forever. They follow a very logical sequence. Step 1, the sponsor signs a guarantee to cover the business plan risk. Step 2, the asset proves itself. Maybe it hits a stabilized occupancy target, or it sustains a minimum debt service coverage ratio. And then Step 3, the guarantee burns off. It either steps down or extinguishes completely. The logic here is incredibly straightforward. The lender required the guarantee for the business plan risk, right? Well, once you actually deliver on that plan, the risk is gone, and honestly, the facility essentially becomes non-recourse in substance.
But here is where sponsors fall into a massive trap. So many of them will just bleed over negotiating the interest rate margin down to the absolute final basis point, but then they'll just turn around and accept the lender's boilerplate template for burn-off language. Guys, that is entirely backwards. Over the life of a transitional facility, negotiating a clean, achievable burn-off trigger at stabilization is often worth substantially more than some tiny margin adjustment.
Now, we also have to talk about how non-recourse protection is highly conditional. Lenders use strict deterrents here. First, carve-out guarantees. This means if a sponsor commits to find bad acts, think fraud or gross negligence, specific losses instantly convert into personal obligations. Then there's springing recourse. If a sponsor voluntarily files for insolvency or intentionally interferes with a lender trying to enforce their rights, boom, the entire loan suddenly springs into full recourse. The primary purpose of all of this? Pure deterrence. It's strictly about stopping sponsors from using tactical moves to frustrate the lender in institutional markets.
All right, final section, Section 5, Pricing the Risk. Let's see how all of this plays out in the real world.
Let's move to and see how this builds our understanding of the market. Recourse appetite changes entirely depending on who you're talking to. Take banks. They are generally recourse heavy. They offer the cheapest senior money, but they almost always require partial guarantees. Insurers, on the other hand, are your traditional non-recourse channel, but they only want prime, long-let assets with incredibly clean exposures. And then you have debt funds. They are highly flexible and actually treat recourse as a pricing variable. Approaching the wrong lender type is literally the fastest way to saddle yourself with totally unnecessary guarantees.
So this is the big mindset shift you really need. Sophisticated sponsors treat recourse as currency. You can literally trade a wider guarantee scope for higher loan-to-value. Or you can offer an interest support guarantee to get a lower interest margin. But you absolutely must define your recourse tolerance before you even start talking to lenders. Why? Because these positions are practically immovable once the actual legal documentation begins.
Let's break down a real-world scenario to make this super concrete. Imagine you're acquiring a £24 million logistics asset. You get two term sheets. Lender A, a debt fund, offers $15.6 million at 65% leverage, but they demand a 25% top slice guarantee and interest support that burns off at a 1.25x DSCR. Then there's Lender B, an insurer. They're offering only $12 million at 50% leverage, but it is totally non-recourse, carve-outs only, and the pricing is 40 basis points cheaper than Lender A.
Now, what's really interesting about this slide is how visually striking the trade-off actually is. Lender A is releasing £15.6 million, while Lender B is only releasing $12 million. That is a £3.6 million difference in capital that you get to keep in your pocket today. But to get that extra $3.6 million, you have to take on that guarantee risk with Lender A. Lender B requires you to write a much bigger equity check up front, sure, but you get to sleep soundly knowing your downside is strictly capped.
And that brings us to our ultimate takeaway. Recourse is never just a label. It's a highly negotiated, strategic allocation of risk between you and your lender. You just have to know what you are willing to trade. So, I'll leave you with this final critical question to ask yourself before your next deal. What exactly is your recourse tolerance, and what are you willing to buy with it? Thanks so much for joining me for this explainer today, and keep making those smart, structured decisions.